Hi, I'm Lex with CommentSection.com. I've recently had a lot of people ask me, from an amateur's perspective, how they get into the stock market and what they have to take into consideration while doing so. I have a degree in finance and have been managing my own personal portfolio for several years now, which has performed very well for me. However, full disclaimer, I am not a financial manager, and any advice or knowledge that you derive from this video and implement is at your own risk. This financial advice also only applies to stocks, not bonds, real estate, or any other type of investments. Now that we got that caveat out of the way, let's talk about the advantages to investing in stocks. Number one, you can buy as little as one share. Number two, they are easy to diversify, meaning you can buy shares of many different industries, whether it's banking, technology, retail, pharmaceuticals, energy, or any other industry you can think of. Diversification is key because it helps lower your risk when you have money in several different areas. Number three, you can divest yourself immediately and have your cash within 3 days. Divesting means basically the opposite of investing. It's turning your stocks back into cash. The stock market allows you to buy or sell at the click of a button. You can't do this with other types of investments, such as real estate, where it could take several months or however long the property takes to sell and receive payment. Number four, historically over time, the stock market in general has greatly outperformed bonds and precious metals. If you invest in an index fund, such as the Dow Jones, which is a combination of stocks, you are essentially betting that the American market is going to continue to grow. Over the past 25 years, the stock market has returned an average of 8% a year. With dividends reinvested, it was 12% return, by far outperforming bonds and savings accounts. Number five, another advantage of investing in stocks is that your stock portfolio can be set up in many different ways, whether it be for optimum growth, income, safety, or a combination of those. Income stocks pay high dividends. Dividends are essentially when a company pays you for an annual percentage of their income just for being a stockholder. Number six, you can customize how much risk you are willing to take and/or perhaps invest in a company that pulls at your personal heartstrings. This effectively allows you to invest at your own comfort level. Now that we have established why stocks can be great investments, we have to talk about the principles that are important to stick to in order to be successful, make money, and limit yourself from as much risk as possible. Firstly, start with money that is not needed for anything else other than investing. What I mean by this is you need to cover your living expenses before you even consider investing in the stock market. You also never want to invest using money that you are saving in order to purchase something of significance. Most important, never use borrowed money to invest because this can put you in extreme debt. Get a good discount broker with an excellent reputation. Discount brokers allow you to make low-cost trades, and it is always better to save money where you can. If you know nothing about stocks, be sure to at least read a little bit about blue chip stocks or what companies people seem to be talking about at the time. Blue chips is a term that is used to describe stocks that are financially sound, high quality, and well established. There are companies like Johnson & Johnson, Google, and Apple, and that they are the most likely to have a record of reliable growth, and in an economic downturn, they are the least susceptible to negative economic conditions. Keep in mind, investing in them costs no more than investing in non-blue chips, and they limit your exposure to market downturns. Safety is another major point when evaluating a stock. You want to make sure whatever stock you invest in is strong financially and doesn't have a lot of built-up debt, because corporate debt, just like personal debt, can lead to bankruptcy and you will lose money. You have to consider your own individual situation. Are you someone that, for example, has expendable income and looking to make a splash in the market? Then you may want to invest more heavily in growth stocks. Maybe you are investing in your retirement or your child's education and would like a steady, modest growth with limited risk, in which case investment-grade, high-dividend stocks are probably a better option. Either way, a well-balanced portfolio should have a mixture of the two, both growth and investment grade stocks, even if one of those two categories makes up 90% of the portfolio. In Stock Investing 102, I will be going over these individual aspects in more detail. Thank you. And please subscribe. Hit the subscribe button.